This mini lecture follows on from the previous one. In the previous one we talked about what depreciation is and why we do it and how we do it. In this mini lecture we're actually going to illustrate the three methods that we referred to in its predecessor. So the three that we will illustrate are the straight line method, reducing balance method, which is also referred to as an accelerated method of depreciation, and the units of production method. So the straight line method is the simplest and easiest to implement. The example here is the purchase of a new motor car which costs $50,000, has an estimated useful life of 4 years, and again an estimated residual value of $10,000 at the end of its useful life. What that means is that they expect they'll be able to trade it in at the end of year 4 for $10,000. Now, to calculate the depreciation expense using the straight line method, remember again what we are spreading is the cost to the business over its useful life, and so it's not a surprise that the formula takes the cost. Now it's the cost which is reduced by what they expect to get back, which is the estimated residual value. So cost minus estimated residual value on the numerator divided by its expected useful life of 4 years. And that then gives us a depreciation expense of $10,000 each year. Method of depreciation, which has this formula calculated as, you can see there, 1 minus root to the n residual value divided by the cost of the asset. Now n there is again its estimated useful life. To apply the reducing balance method, often we find quite a useful shortcut, and that's done by approximating that formula by using a multiple of the straight line rate. So the multiple could be 1.5 times or 2 times the straight line rate. Let's illustrate what that means. The straight line rate, in this example here, if the useful life was 10 years, then the straight line depreciation rate would be 10%. That's to say the asset is spread over, its cost is spread over 10 years, which means 10% each year. So using that approximation of the formula, if we used double straight line, then the rate would be 20%. Or if we used 1.5 times straight line, then the rate would be 15%. Now in the next overhead, let's look at the different way that that is applied in this reducing balance methodology. This table illustrates the schedule of how depreciation changes over the useful life using the reducing balance schedule methodology. Now recall that when you're using straight line depreciation, the nature of the formula will be that each year the depreciation expense will be the same. Here you can see, using the reducing balance methodology, that the depreciation expense is actually very much greater in the early years of the life of the asset, and it shrinks down to a very small amount when the asset is getting quite old and towards the end of its useful life. Now that's because of the nature of the formula. It's the formula that forces it into this pattern. Also, see that reducing balance is applied to the balance. In other words, it's based on the reducing balance each year. And so the opening balance of $50,000 is reduced to its written down value at the end of year 1. It's that reduced or written down value which becomes the depreciable amount for year 2. And so the formula is then applied to the already reduced amount for year 2. And you calculate a depreciation expense which necessarily will be different from what it was in the first year, because you're applying it to a different figure on the numerator. And so in the first year we have 18,750 depreciation. In the second year, 11,719. Notice that the written down value declines, of course, very quickly as a result of that in year 1, not quite as quickly in year 2, less quickly for year 3, and really very slowly by the time you get towards the end of its useful life. Now, what the pattern of this actually means is that as the asset gets older, the dollars of depreciation each year become smaller. And so your profit in earlier years is taking a bigger hit with a bigger amount of depreciation expense. So what's that difference look like? Well, using straight-line depreciation, which is simple and convenient, what we get is a pattern that says the expense in early years of the life of the asset will be lower, and therefore the profits in those earlier years will be higher. And the flip side for the reducing balance methodology, first of all, it's more complex to calculate, as you've just seen, but because the expense is higher in the early years, that means that correspondingly the profits in the early years will be lower. The third method is similar in meaning to the straight-line depreciation methodology, except that instead of spreading the cost over a useful life which is defined in terms of years, we spread the cost of the asset over a useful life which is defined in terms of the units of production. And so in the example here, we're talking about some capital assets which are in place to produce 100,000 ounces of minerals, in this resources example, and will have a zero residual value. So 100,000 is the total productive capacity over its useful life. Now, if in the first year they produce 10,000 ounces, then you and I can quickly say that the depreciation expense for that first year will be 1/10 of the cost of $10 million. So let's see what the formula looks like. It's the same on the numerator, the cost minus its residual value, in this case estimated to be 0. So $10 million, its residual value of 0, and the formula then says how many units did we produce in this period of time, divided by the total number of units of production over its useful life. And so there's the 10% that you and I just calculated, and the depreciation expense for that year will then be $1 million.